So what about gaps from the past? There's a tendency for gaps to be filled from the past, but they also, if the gaps are above you, they serve. If a gap down, let's say, for instance, let's do this. So if a stock went up like this and then gaps down here, right? So it was going up, but then gaps down. This gap, if you fill it, right? Fill it in, that is a red bar, right? And so remember that's this. So you take the range of the red bar. If the stock goes into that gap in the future, the turn is very highly likable, very high, just like this red bar. If you go back into that range of that red bar, you're likely to get this. The gap is a red bar to the downside. You go into that gap, it's just like going into a red bar. All right. Got it, Gregory? Okay, cool. Now, someone kept asking about volume. Why don't we place a lot of emphasis on volume? There are a couple of reasons why. Number one, volume is now one of the most overrated technical concepts in existence today. It is not, it does not hold the importance that it used to hold when I first started getting into the game. So I would say that volume started to become broken down and less important mid to late 1990s. As we got into the early 2000s, it was a concept that you're going to be a loser if you focus on volume for anything significant. And the reason for that is because of how fragmented the market became with the advent of ECNs, electronic communications networks. And so instead of all volume going through one funnel, here's the volume going through one funnel. You now have hundreds of funnels to go through, which breaks up it dilutes the effect of volume going through multiple funnels. And it now take a portion of those funnels, take this portion of the funnels and that portion of the funnels, and then make them disappear. They're called dark pools of liquidity, where the volume doesn't even show up. So if you shoot any orders in these funnels or shoot any orders through these funnels, they don't even show up in your volume numbers. So now the volume number you see is devoid of what's really going on. So that's one reason. It's most volume today is hidden, not like in the old days where none of it was hidden. Okay? Now, this should be against the law, but it's not. All right? You call going public in the market, an IPO is going public. Why? Because the market's supposed to belong to the public. So whenever you start hiding things from the public, it should be illegal, but it exists. And have I used them? Yes, in a big way. So I can't complain. So anyway, that's one reason. The other reason, which is actually even more important than this, is the fact that volume helps lift or drop a stock. All right? Okay? But I want you in the stock before the volume comes. So let's take, for instance, something like this. Stock is pulling back after a move up, right? Now, I want you getting in here. Your entry there will be before there's any volume effect. If after your entry this bar grows, you will subsequently see that volume bar grow. And so if you're waiting for this to happen first, you're always going to be a late enterer. You're getting in before the volume spike there. In addition to that, statistically, big volume always tends to happen a bar or two later after a turn. So volume comes in after the turn is evident. So most big volume bars will happen on the second bar after a turn when your signal is to get in there. And the volume happens here. Does that make sense? Because the turn is evident, so people rush in after the evidence. Okay? And so if you're waiting for volume spikes, you're always going to be late.